Ben, thanks very much for being here. So Ben is a general partner at Bolt, which is a seed stage fund in Boston that focuses on hardware, or the intersection of hardware and software.
Yeah.
So do you want to maybe tell us a little bit about the fund, the history, your history?
Sure. Yeah, I'm a product designer, so I used to run a design consultancy. You're probably all familiar with like IDEO. Smart Design is big in New York City. Frog, all those guys. I ran a. Is this okay? It's not working. Oh, got to do the close thing.
Hardware.
Yeah, so I used to run a design consultancy very similar to IDEO or Frog Design or Smart Design that you guys have probably heard of before, doing new product design and development for mostly large companies. That's typically where most of the money is spent on in sort of the consulting world. And found that hardware startup companies actually have all the same problems, but none of the money to pay for consultancies. And probably if you guys are designing some of your own products, you probably would love to be able to have the help from someone who's done this before. But paying $500,000 to a design consultancy when you don't have much money is usually not a very good idea for a bunch of reasons we can go into if you want. And so we started this pretty weird venture firm called Bolt, which is based in Boston and San Francisco. And the idea is that when we make an investment, which is fairly small in the sort of $100,000 to $500,000 range, we spend a ton of time with the companies helping them go through product development. And so we do that with a shop facility we have in each location in Boston and San Francisco, about $20 million of equipment that the companies can use as part of the investment that we make. And then we have a full staff of engineers and designers that work full-time for us that spend all of their time working with the portfolio companies to help them think through things like prototyping and molding and cost of goods and firmware and industrial design and all those things that you guys are worrying about, all on the hardware side. And these guys have shipped about somewhere in the order of about 85 million units of product between them.
You want to give us some examples, 3 or 4 companies in your portfolio that you're excited about?
Totally. I don't know if it was on the screen, but one of the products that's in beta is a company called Mural, which is based in New York City. They built this really cool connected art frame. So sort of like Spotify for art, you have a service for art that you subscribe to.
They actually spoke here.
Oh yeah, cool, great.
Maybe last year they were very good.
They're wonderful. And so, but it's really all about selling art. And we made this great point about the subscription stuff, and really sort of recurring revenue is really a thing that we really optimize for. So of the 40 portfolio companies we've invested in so far, I think 38 of them inherently are built around recurring revenue, which is really important for the way we think. Another New York company is a company called Dip Jar, which is actually, I think, 2 floors below us here. It's a little tipping jar for credit cards, so you can put that in a coffee shop, or they actually have a lot of charity customers, so March of Dimes and Children's Miracle Network and all these guys, to rather than using cash and checks for donations and for tips, you can actually use your credit card. Really cool, simple little product design, and then a service on the back end that monetizes the credit card charges.
And maybe quickly, which company of all your portfolio is the most advanced in terms of having raised multiple rounds?
I love all of my children equally. Yeah, I mean, I think it depends. In terms of like units shipped, probably the best is a company called PetNet, which is nationally distributed, Best Buy, PetSmart, Petco, all the big pet retailers. I've sold many thousands of units, but it's still early days. We started the fund 3 years ago. That was our first investment. I think if you look at money raised, we have companies that are in the multi-$100 million range, like Desktop Metal. It's sort of just a huge gamut of companies. I try not to judge too hard until money is in the bank and you can buy beer with it, as my mentor says. I think it's really important to not get ahead of yourself on like valuation and all that stuff, which a lot of investors really pay attention to. I know we agree on this, but a lot of other people don't, especially in Silicon Valley. So yeah.
Okay, very cool. You wrote a fascinating blog post. So by the way, I would invite everyone to. Do you publish on Medium mostly?
Yeah, it's Medium, but it's branded as a blog.bolt.io.
Yep. So there's a number of interesting posts by both you and Chris as well.
Thanks.
And there's one that I particularly liked, which was essentially. That's this one sentence that we've heard here many times, which is hardware is hard. And so you were sort of debunking that, and I had some notes here, if I can find them. So there were 3 myths. Hardware requires more capital. Hardware takes longer. and hardware is less profitable.
Yes.
So I'd love to hear.
Happy to talk about them until no one wants to hear us talk anymore. I think there's a sort of I would say like linguistic coincidence that the word hard occurs in the word hardware, and so I'm sure many of you, including myself, have said this phrase before.
Keep the mic close.
Oh, sorry. I think many people have heard this phrase before, and it's frustrating because many companies are hard to build. In fact, I'd argue that all companies are hard to build. And if you talk to whatever Travis at Uber or the Google guys or whatever, and say, was this an easy thing to build a company? They would say, "What are you, crazy? This is the hardest thing I've ever done in my entire life." And so I think people that are building hardware companies also have, it's really hard. I'm not saying hardware is not hard, but I'm saying everything else is also hard. And so it's really important for me to put in context of like, there's lots of things in the world that have to get done through hardware. Most of the things we interact with, most of the money that's spent by consumers is all physical stuff. And saying that it's hard sort of defeats the purpose of encouraging entrepreneurs to build companies that are building physical products. So it's not to say that it's easy. It's to say actually everything is challenging, and it's really important to focus on that for our perspective. Now, I'm slightly biased because all I invest in is hardware, but I do think it's really important to motivate people to build physical product companies. So in terms of hardware is more expensive, this is probably the worst misconception about starting a hardware company, and it comes from the fact that the earliest days of building a hardware company are actually more expensive. It takes more money to get a product out the door in the first 18, 24 months of building a startup company than a social media app that you can build in a whatever, Starbucks. The difference is once the machine in hardware starts to work, once you are in retail and you've built inventory and you understand your margins and you understand how to deal with factory financing and all these alternative forms of financing, they're actually more cost efficient, at least for consumer, sort of like large-scale consumer companies. I think my favorite example is Fitbit. I'm sure you all know Fitbit. They've raised $77 million when they went public. They were at a $1.9 billion run rate, which is unprecedented in terms of IPOs for startup companies. So
versus a Box or SaaS companies that raise hundreds of millions of dollars.
Right. That's right. So Box, I think, has raised $200 or $300 million. They are, I think, when they, I don't actually know where their S1 stuff is, but they were barely profitable or not even profitable, and that's okay. I think the public market is okay with that. They're investing in future revenue, which is what all investors are investing in. But I do find it frustrating that people complain about the capital intensity of hardware businesses. In the long term, it's actually, in many cases, more capital efficient. And again, this is dependent.
Can you expand on that? So what happens then? Why does it become less capital intensive in the later stages?
Yeah, so there's a phase in hardware which is extremely painful, which is the beginning of which is product development. You are paying lots of money. It takes longer to sell the first unit than it does to launch the first SaaS customer or whatever. And so there's this pain you feel there. And then right on the back side of that is the pain of building inventory, which many companies have to do to deal with physical retail. Best Buy and other stores will require things like backstock, and you have to have thousands of units that are sitting in their control and all this stuff, and you have to pay for that up front. And so getting to the ramp phase of a hardware sort of commercial sort of growth story is expensive. But then after you get to a certain point, you're at that steady state. People are paying you for your product relatively quickly in the full price plus the margin, right? So if you look at, let's see, a company where you pay for a service like Box, you mentioned Box, you're paying whatever, a couple dollars per month to use that service. There is a pretty expensive cost of customer acquisition in the front of that service that has to be monetized over many years. And so the financial metrics are just really different for a SaaS company than a traditional hardware company. Where this business model gets really interesting is when you do both. So if you are in, let's say Dropcam is one of the best examples of a consumer company that's able to monetize on both sides. You're selling a product that costs you $35 to produce in China. 2 months later, you're being paid back for that full expense plus the margin plus all the other things that you've spent on, and then you're collecting from 45% of your customers, $9 a month on a storage service at 80% or 90% gross margin. Those businesses are super, super interesting. It's also why Fitbit is so successful. They had 10 million people paying $50 a month to use their product. $50 a year. So that's really where these businesses, sort of connected hardware stuff, gets really interesting, and why we're totally focused on companies that have recurring revenue.
Now, at what point do you see economies of scale kick in? I mean, how many? What does that mean in reality? Like, how many units?
It's tens of thousands of units a month, so it's real scale. I think one of the rules that we use with consumer products that are less than $500 is you have to sell 1 million units in the life of the company. And if you can't hit that number, you should go home or do something else, or charge more for your product. And it's sort of a hard reality to deal with when entrepreneurs are forced to think about, wow, what does selling 1 million units look like? It's a huge number of things to be building and to be supporting and maintaining and all this other stuff. I find it very helpful to think through when we're looking at companies like, wow, can I imagine this founder shipping 1 million of these things? And oftentimes the answer is no, for one reason or another. And so you know, you sort of get to back of the envelope math of economies of scale when you're building 10,000 units a month. That is a fairly successful company, right? Once you've hit that point, you know you're going to continue to grow. And so that's where, you know, CMs start giving you huge lines of credit. You really don't have to raise money anymore from private VCs to finance production, which is where the sort of scales start to tip in your favor.
And you want to address quickly the other two? So hardware takes longer, and hardware is less profitable?
Yeah, so this is really a question of what does take longer really mean, right? And so if you are talking, again, about product development and shipping the first units, absolutely, it takes longer. The first customer you will have will take longer than the first SaaS customer than you're going to, if you're building a social media app or whatever. And again, I'm sort of an idiot when it comes to software, so forgive me for the lack of terms. On the like, it takes longer side, I think the real bar, at least for us, is success as a business. And so when do you know that the company is working? And in many cases, I think that's actually sooner in hardware companies because of the way money flows. Again, it's sort of based around the same point around people are willing to pay for a product really quickly and upfront, which is a very nice thing that happens in the hardware world that does not happen in the software world. So if you look at a company like Facebook as an example of a really successful company, no one really knew if that was going to generate, you know, billions and billions of dollars of revenue until they figured out how to do advertising, which was years after the company had scaled. So not that they're a bad company or anything, but that time that it takes to figure out, is this going to be a real business that the public markets are going to love, can take many, many, many years. Again, the handful of companies in the hardware space that have been acquired or gone public are, you know, it's on the order of 6, 7, 8 years, which is, you know, in the same realm as traditional software companies. So it's not like hardware takes double the amount of time to become a successful company. It might take double the amount of time to ship your first unit and have your first customer. And so it's a little bit of a clarification of like what the constraints are and the bounding box is on what, you know, longer actually means.
Okay, great.
And what was the third one? There's another one.
Less profitable.
Profitable, yeah. And this is really, again, driven by the fact that business models where you're doing an upfront sort of hardware, you know, 30, 40% gross margin sale at retail, coupled with 80, 90% margin recurring sale, winds up sort of getting the best of both worlds. You have, you know, a sort of a really interesting margin structure on the hardware sale, which is sort of traditional and nice to have, and you have this incredibly interesting recurring revenue on someone like a Fitbit or a Dropcam, where they're able to continue to monetize that product over time. And this is just the consumer products. There's a whole host of enterprise applications that have similar sort of advantages. They don't have to build inventory in the same way that B2B or that B2C customers have to build or companies have to build, but there's a definite focus on recurring revenue for a lot of investors that are focusing on the hardware space.
Great. You had another very interesting analysis on Coin.
Yes.
So Coin, for people, I don't know if people know, so that was this very buzzy connected device. The whole idea was that it was going to replace all your credit cards. So you basically could have all your credit cards in just one device, and you could switch, or it actually could recommend how to switch when completing a transaction. Yeah,
it's the black sort of box-looking thing on the sort of the top right quadrant over there. And
that went, so that got crazy hype, plenty of investment, great founders, but that failed. Yeah, pretty bad. That eventually the company was acquired by Fitbit, but that was essentially a failure. And so it had all the markings of a great company, and it didn't. And you had some interesting analysis about why that happened and what we can all learn from it.
Yeah, and so I have this pretty strong thesis around the combination of product risk and technical risk. Technical risk, I think everybody understands. You know, is there a chance that I'm not going to be able to manufacture this thing, or it's going to not work very well, or whatever the problems might be? And so, things that have really high technical risk are things like Roomba. If you've ever bought a Roomba and taken that thing apart, it has 150 molded parts, it has crazy motors and electronics and all these like really complicated things going on. There's a chance that that thing just could not be made at the price that made sense. And a whole host of other, if you look at SpaceX or Tesla, companies like this, they have crazy high technical risk, and I think people are pretty familiar with that. There's a concept that we love at Bolt and really analyze every company around what we call product risk, which is, this is sort of a little illustration of what that looks like, is sort of high and low product risk. I'm sure there's a spectrum in between, but we really try to divide companies into one bucket or the other. And these are products where if the product fails, how does the consumer feel about that experience, right? So if you have a Fitbit and you walked 10,000 steps and it only recorded 9,000, you probably don't even know, right? So even though that's technically a failure, it didn't live up to what it's supposed to do, it's a low risk sort of proposition to the consumer. If you have a pair of headphones, I don't know, you buy a pair of Beats headphones or something, and whatever, the cable doesn't work right, or the color's a little off or whatever, it's not the end of the world. It's just a set of headphones, right? You might return them, you might have a complaint or something, but it's a low risk product. If you have a coin, and this is the thing that you're using to pay for things in a store, and you go to swipe your credit card, like I did when I got one, and it doesn't work, you feel like an idiot trying to pay for things, and you can't afford the latte or whatever that you just bought, and you have to return it, or not even pay for it, I guess, and you feel pretty dumb, right? If you have, another one I love to talk about is August, or any of these smart lock companies, right? If your smart lock, this happened to me, my smart lock didn't work, and I had to crawl through my back window to get into my house. That's not a good experience that you really want to have, right? And so I think companies can do one. They can do either high product risk or high technical risk, but they can't do both. And so the big failure, in my opinion, with Coin was that it's actually a really hard thing to do. You look at a normal credit card, it's a little piece of PVC, they have a little magnetic stripe on the back, maybe a little colorful printing on the front and your name or whatever. It's a pretty simple thing to build a credit card. Now imagine cramming an OLED display and a button and a battery and a Bluetooth radio, and there's an electromagnetic transducer, super complicated stuff all into the same form factor. That's a really hard thing to do. At the same time, you have high product risk, right? If this thing fails and you can't pay for the latte or the car that you just tried to rent or whatever, you're shit out of luck. And now you feel pretty awkward and you're sort of scared to use it again. And so we have this very strong belief, I think I can change the slide, there you go, that you really want to be in certain quadrants of this graph. Being in the top right is really bad. And companies that are in that sort of quadrant of the graph where you have both high product risk and high technical risk are pretty much impossible to become successful, just because of the dynamics of building a company. So there are a handful of examples. I would say maybe Tesla is in that example. If your car doesn't work, that's a huge problem, and yet it's also technically really risky. But Elon Musk is an exceptional entrepreneur, and that is not a company that the average person should start. I think all the other categories can be good. Obviously, the best category to be in is the bottom left, when you have low product risk and low technical risk. If you look at a company like Fitbit, it's an accelerometer that costs $1, has a little display and a battery and a Bluetooth radio. The cost of goods is like $6 or $7, and if it doesn't work that well, it's okay. And so that is a fantastic place to start a business. Now those are also the companies that are most open to being commoditized, and so that's where brand matters the most. And so there's a whole other story around how brand interfaces with product and technical risk, which maybe we don't need to get into.
And what's tricky from an investor perspective is that a lot of the high, product risk companies are the companies that tend to be the products that tend to be more mission critical, right? So the flip side is that if you have a lock and you love your lock and your lock works, that becomes something that you're just completely addicted to, right? That becomes part of your daily life. So the sort of intersection of all those categories is pretty small, right?
It is definitely, it is really hard to find products that fit into those categories. I think that is, in many ways, that's what CEOs should do when they are setting out to solve a problem. That problem should be thoughtful about the types of risk that you're undertaking as an entrepreneur. I think many people don't think about it that way. They say, hey, I have this problem that I noticed and I really want to solve it and I'm going to spend my whole life solving it. And that's great, but I think the entrepreneurs that think carefully about what type of risk they're sort of signing up to take inherently is actually really a good step to do in the beginning stages of building a company. And not that any risk is intolerable. It's about managing the types of risks that you're dealing with. And I'm not saying any of these things are bad. It's just that it's harder to do certain parts of this than others.
Okay, great, thanks. I want to start opening up to questions. I have a couple more, but if somebody has one, yes, do we have a mic anywhere or no? We don't, okay, all right, I'm going to share.
I was just wondering about what I might say the world moving around you risk. And to take coin for an example, okay, I've never actually tried to use one, but say it worked perfectly and everything was great, and then starting this year, suddenly everything is chipped rather than swiped, and you can't clone the chip, so there's no way to do that.
Yeah, that's a good question. We call that ecosystem risk. I think it's sort of the same thing. And the idea is that you are subject to the environment that you're putting this product into, right? So if you look at a company like, again, I'll just keep using Fitbit because their image is right there. You know, that environment is pretty consistent, right? You're on a wrist. Maybe the wrist changes in size or different types of people or whatever, but it's more or less the same. You have to design it to be waterproof and all the other things that can be challenging. But the fundamental dynamics of that problem are going to be the same. If you look at a company like August, the smart lock, that's actually really complicated ecosystem risk because you have to integrate into hundreds of different types of door sets and knobs and handles and different alignments of the door and different wood things and drilling holes. It's this very sort of heterogeneous, complicated environment. I think that there's also an element of that of time as things change over time. With the coin example, they obviously were working, before they failed, were working on chip and pin cards. It is something that requires a hardware upgrade and an additional sale. Luckily, the cost of goods on that is actually lower than you'd expect. But it is it's sort of product line development, and you have to be aware of that as any hardware company goes through growth of building out their SKUs over time. It is something that you should think about. I think it's less critical than the sort of technical versus product risk sort of dimension that we think about.
Good. Oh, another question all the way in the back.
So you mentioned coin. Thanks. So you mentioned coin.
Yeah.
I wonder how long it takes from the time something quote unquote fails until you realize that it could be like a Web 1.0 versus Web 2.0 conversation, and you give it another chance in a different market, a different ecosystem, or like another product market fit or something like that.
So you're really asking about when a company fails, is that really driven by the company being, the product being a bad idea, or just a timing thing? Okay. I mean, I think the answer is that it doesn't matter, unfortunately. And I think you don't know that something works until you do it and it occurs and it changes the world and people love buying it and it changes their lives. And unfortunately, it's a really hard thing to predict. And I think many investors deal with this every day. It's very hard. Is this a really good idea that's too early or too late for its time? And it is something that I think probably keeps us up at night a lot. I don't know. I think it's one of actually the hardest parts of investing is knowing when something seems like it's a problem that should be solved. There have been tens of billions of dollars of venture capital wasted on companies that were fantastic ideas at the wrong time. And it's something that is sort of one of the big X factors in building a company. I think, we could point to a list of examples. Webvan is probably a really, noticeable company. If you all remember that company, which was, hugely sort of successful in terms of raising money and ultimately failed. Amazon is now doing the exact same thing, or Instacart is the exact same thing as Webvan, to great, I think, sort of great acclaim. So there really isn't, unfortunately, a great way to think about sort of time disruption. I don't know, maybe you have a thought about that you think about in terms of how do you sort of know when it's now is the time for a company to start?
No, I don't.
Okay. Well, if you figure it out, let me know.
Do we have another one? Yep.
Hi, Vivek here. My question is, so we talk about lean product development, and in software, it's easy to experiment and get feedback from your customers and change your software. How do we do that with hardware? And what happens when we invest a lot of time in design and building the perfect hardware and then we need to change?
If you are making the perfect hardware and showing it to someone, you're doing it wrong. Just like in software, right? I actually view these problems as almost identical, and unfortunately, people misunderstand them. I spent my entire life in product development. It's all I do. It's like sort of my main focus in life. And the mistake that people make is they believe that in order to demonstrate a product to a customer, it has to be perfect. There are many software people that think the same thing. In order to show a potential customer if their product is going to be successful, they have to have it developed past a certain point. That turns out to be pretty wrong, actually. And so in the hardware world, you learn how to test things kind of like science experiments. You're controlling variables, you're trying to minimize the number of things that are going on in any given time, and you're trying to break down a product to its sort of essential pieces in order to understand how people react to that piece of a product. So an example might be if you have a product with a handle, you can actually just test different forms of that handle attached to a weight or something without having the rest of the product to know how that handle is going to sort of respond. Now, of course, there is an X factor of what happens when you put all these pieces together and how do people react with the product then. And of course, in order to do that, you have to have what we call an EP, an engineering prototype, which is sort of a combination of a looks-like prototype and a works-like prototype. And that is, that's typically a 9 to 12 month process to go through that sort of phase of development. I would also argue software has a similar thing. You really don't know how well a software product is going to work until a certain percentage of that product is all put together. So it's actually more similar than different.
Right. One last quick question, if we can keep it reasonably short.
Hi. Thanks for coming. Not an insider, but it still feels like the phrase that you mentioned, that a lot of investors are still hung up on hardware is hard. And I know you touched about a lot of issues like risk and timing and all that, but when pitching hardware to investors, let's say hardware-friendly investors, is there a number one thing, most important thing, or 2, 3, something like that?
Yeah, so that's a great question. The importance of knowing how to talk about hardware is really important. I think the mistake that a lot of people make is they get really excited about things like prototypes and or like manufacturing and costs and these kinds of things. They're all part of the story. Software is a lot more similar to hardware than people would think. At the end of the day, what really matters when investors are looking at a hardware company is, do they love the entrepreneurs and the team that's being built, and do they believe in the market? And there's oftentimes other things that people think about, like product potential and the vision of the founders, other things like that. But usually those two things, I would guess if you surveyed 90% of venture capitalists, they would say those are the number one and number two things that they look for: really good people and a really good market. And I think at the end of the day, that's really what matters the most. So if you hire well, and if you're playing in a space that people believe a multi-$100-million revenue business can be built, you will raise money. No questions asked. You might have to go to specific people. It might take longer than it would if it was a software company. You might have to get to a certain point in the prototype development or the product development. You might have to, prove the market with some sort of crowdfunding thing or something. There might be other things you have to do, but you will raise money if you have those two things nailed down.
Great. On that note, thank you very much. That was
Thank
awesome.
you. It was a pleasure. Cheers.